Something broke. Not slowly, not gradually, but structurally. An entire market lost its operational logic, while everyone kept participating as if nothing had changed. And that is exactly what makes the phenomenon dangerous, because visible collapses trigger reaction. Invisible collapses produce confusion. And what we see today is confusion at global scale. The signals are too consistent to be coincidence. The cost of capturing attention has surged. Average interest duration has collapsed. Substitution has become instantaneous. Retention has become exceptional. This does not describe isolated personal experiences. It describes a market environment in structural imbalance. Most people interpret what is happening in personal terms. They believe they failed to compete, that they lost value, that they became less desirable. But markets do not collapse because individuals simultaneously deteriorate. Markets collapse when the pricing mechanism stops reflecting real value. And that is exactly what happened here. Something broke, not slowly, not gradually, but structurally. An entire market lost its operational logic, while everyone kept participating as if nothing had changed. Because visible collapses trigger reaction, invisible collapses produce confusion. And what we see today is confusion at global scale. The signals are too consistent to be coincidence. The cost of capturing attention has surged. Average interest duration has collapsed. Substitution has become instantaneous. Retention has become exceptional. This does not describe isolated personal experiences. It describes a market environment in structural imbalance. Most people interpret what is happening in personal terms. They believe they failed to compete, that they lost value, that they became less desirable. But markets do not collapse because individuals simultaneously deteriorate. Markets collapse when the pricing mechanism stops reflecting real value. And that is exactly what happened here. For most of human history, relational value was discovered through an extremely simple mechanism. Repeated exposure under natural scarcity. You encountered the same individuals continuously. Value was not declared, it was progressively revealed. This model had three fundamental properties: sufficient time for real observation, limited supply of alternatives, comparison restricted to the immediate environment. These three conditions stabilized the system. Value emerged naturally because time functioned as a verification instrument. Time revealed reliability. Time revealed character. Time revealed emotional stability. Time was the primary mechanism of human value discovery. Then time lost power, and whenever time loses power in any evaluation system, distortion becomes inevitable. What replaced time? Screening speed, mass comparison, continuous exposure to alternatives. The old model was based on familiarity. The current model is based on filtering. Filtering is faster than knowing. Filtering is cheaper than investing. Filtering is safer than deepening. But filtering does not measure value. Filtering only eliminates options. This shift appears subtle. In reality, it destroys the foundation of the market. Because the human brain was not designed to process choices in these proportions. It was designed to recognize quality in small groups. When exposure is massive and instantaneous, the brain switches from evaluation mode to efficiency mode. In efficiency mode, the brain does not look for the best. It looks for the easiest to categorize. It looks for the obvious. And here is the tragedy of the modern player. You can be a person of immense internal value, with a deep character and rare consistency. But if those qualities require time to be noticed, the current system will eliminate you before you can even speak. The market has stopped rewarding the deep. It has started rewarding the indexable. Being indexable is not about who you are. It is about how quickly you can be categorized. This is why high-value individuals are disappearing from the visible market. They are not losing the game. They simply stopped playing a game where the rules were designed to ignore them. They migrated to private markets, reputation markets, referral markets, where time still has power. Meanwhile, the public market has become a high-frequency simulation, where everyone is competing for an attention that no one has the capacity to give. The question for you is not how to compete in this noise. The question is how to build your own signal. Because in a market of total distortion, the most valuable asset is not attention, it is trust. And trust cannot be indexed, it cannot be automated, and it can never ever be rushed. Welcome to relationship economics. This is not about being visible to everyone. It is about being undeniable to those who matter. It is about exiting the noise of the public simulation and entering the clarity of the private signal, shorting the system. The system is unstable, but instability creates opportunity. Every distorted market produces arbitrage. Every bubble creates a counter-trade. Every collapse transfers value from the unaware to the strategic. The dating economy is no different. You are not required to participate under current pricing conditions. You are not obligated to compete inside a hyperinflated marketplace. You are not forced to trade long-term assets for short-term visibility. You can short the system. Not emotionally, structurally, because the core vulnerability of any inflated market is dependence on attention liquidity. Remove attention and valuation collapses. First principle, exit the commodity exchange. If you are displayed, compared and ranked in infinite scroll environments, you are not an investor. You are inventory. Inventory competes on visibility. Visibility decays instantly. Scarcity restores pricing power. Opacity disrupts algorithmic comparison. In simple terms, assets that are not constantly displayed cannot be constantly devalued. Most participants optimize for appearance metrics, visual stimulus, social proof, immediate engagement yield. But signaling assets behave like speculative tech stocks. They spike rapidly, they crash unpredictably. Most participants optimize for appearance metrics, visual stimulus, social proof, immediate engagement yield. But signaling assets behave like speculative tech stocks. They spike rapidly, they crash unpredictably. They require constant reinvestment to maintain perceived value. Internal assets compound differently. Cognitive capital, emotional regulation, physical discipline, financial independence, reputation stability, network quality. These are slow growth instruments, low volatility, high durability, extremely resistant to commoditization. They are difficult to replicate, which means they are difficult to replace. Low replaceability is the foundation of real market power. Third principle, reallocate time from acquisition attempts to asset appreciation. Most individuals spend their highest energy years chasing transactions, messages, validation loops, positioning games, micro-rejections, constant re-entry into unstable exchanges. This is high-frequency trading in a declining market. Transaction volume increases, net return decreases. Strategic investors behave differently. They reduce trading frequency. They increase asset quality. They allow value to compound before re-entering any exchange. When they appear, pricing adjusts automatically. No persuasion required. No signaling inflation needed. Value recognition becomes passive. Fourth principle, understand timing asymmetry. Short-term markets reward intensity. Long-term markets reward endurance. Hyperinflated dating environments peak early. They favor rapid stimulus cycles. They penalize patience. But inflation is unsustainable by definition. Over time, stimulus fatigue emerges. Comparison exhaustion rises. Attention fragmentation increases. Trust scarcity intensifies. When trust becomes rare, stability becomes premium. When stability becomes premium, slow growth assets reprice upward. Those who invested early in durability experience delayed but massive appreciation. Those who optimized for visibility experience depreciation after peak exposure. This is not philosophy. This is life cycle economics. Fifth principle, become a closed system of value generation. The public market requires external validation to determine price. A closed system generates value internally. It does not wait for the market to signal its worth. It dictates its terms by its own presence. Conclusion, redefining the objective. The goal is not to be chosen frequently. The goal is to be irreplaceable. In a world of high-frequency trading and rapid depreciation, the ultimate arbitrage is stability. The crash already happened. Most people are still trading like it didn't. The question is no longer whether the market is broken. The question is whether you are still pricing yourself inside it, or building something that doesn't need it at all.